Hello and welcome to our channel. In today's video, we're going to discuss one of the most concerning topics for investors, the warning signs of a potential stock market crash. As the stock market is subject to volatility and uncertainty, it's important to stay informed and know what to look out for. In this video, we'll be exploring the top 10 warning signs that could indicate an impending market crash. So, let's get started. Warning sign number 1. High market valuations. First on our list of warning signs is high market valuations. When the stock market is priced higher than its underlying fundamentals, such as corporate earnings and economic growth, it is considered overvalued. In other words, the stock prices have risen faster than the actual value of the companies. One way to determine if the market is overvalued is by looking at various metrics such as the price to earnings ratio, the price to sales ratio, and the cyclically adjusted price to earnings ratio. These ratios help investors to evaluate the value of a stock in relation to its earnings, sales, or other fundamental measures. A high price to earnings ratio indicates that investors are willing to pay a premium for a company's earnings, which could be a sign of overvalued stocks. The price to sales ratio measures a company's stock price against its revenue, and a high price to sales ratio suggests that investors are paying more than the company's actual revenue. The cyclically adjusted price to earnings CAPE ratio, also known as the Shiller price to earnings ratio, compares a company's current price to its average earnings over the past 10 years. A high CAPE ratio implies that the market is significantly overvalued. In the past, high market valuations have often been followed by a market downturn, as stocks eventually return to their fundamental value. Therefore, it's important to monitor market valuations and exercise caution. When the market is showing signs of being overvalued, consider rebalancing your portfolio and increasing your allocation to a warning sign number 2, rising interest rates. Another warning sign to watch out for is rising interest rates. Interest rates can have a significant impact on the stock market as they affect the cost of borrowing and the return on investments. When interest rates rise, borrowing becomes more expensive, which can lead to a decrease in consumer spending and corporate profits. Higher interest rates also make bonds and other fixed income securities more attractive compared to stocks, which could lead to a decrease in demand for stocks. In addition, rising interest rates can lead to a strengthening of the US dollar, which can negatively impact companies that rely heavily on exports. When the US dollar is strong, it makes exports more expensive, which can reduce demand and ultimately hurt corporate profits. Therefore, investors should keep an eye on interest rates and how they may impact the stock market. If interest rates are rising, it may be time to reassess your investment strategy, especially if your portfolio is heavily weighted towards interest rate sensitive sectors such as real estate or utilities. Warning sign number 3, economic slowdown. The third warning sign of a potential stock market crash is an economic slowdown. The economy and the stock market are closely related, and a decline in economic growth can lead to a decrease in corporate profits and ultimately a decrease in stock prices. An economic slowdown can be caused by various factors such as a decrease in consumer spending, a decline in business investments, or a decrease in exports due to a global economic downturn. In addition, geopolitical tensions or a sudden change in government policies can also impact the economy and the stock market. One way to monitor economic growth is by tracking the gross domestic product, which is the value of all goods and services produced within a country's borders. If the GDP growth rate is declining or has turned negative, it may be a sign of an economic slowdown. In response to an economic slowdown, investors may want to consider reducing their exposure to stocks, particularly those that are sensitive to economic conditions such as consumer discretionary, industrials, and materials. Instead, investors may want to consider defensive sectors such as healthcare, utilities, or consumer staples, which tend to be less affected by economic cycles. Overall, an economic slowdown can be a significant warning sign of a potential stock market crash, and investors should keep a close eye on economic indicators to make informed investment decisions. Warning sign number 4, falling corporate profits. Another warning sign of a potential stock market crash is falling corporate profits. Corporate profits are a key driver of stock prices, and if they start to decline, it could indicate that the economy is slowing down or that companies are facing challenges that are impacting their bottom line. Falling corporate profits can be caused by various factors such as increased competition, rising input costs, or declining demand for a company's products or service. In addition, changes in government policies or global economic conditions can also impact corporate profits. One way to monitor corporate profits is by tracking earnings reports, which companies release on a quarterly basis. If a company's earnings report shows a decline in profits, it could be a warning sign for the broader stock market. In response to falling corporate profits, investors may want to consider reducing their exposure to stocks that are particularly vulnerable to profit declines, such as cyclical sectors like technology or consumer discretionary. Instead, investors may want to consider more defensive sectors such as healthcare or utilities. Overall, falling corporate profits can be a significant warning sign of a potential stock market crash, and investors should stay vigilant and monitor corporate earnings reports to make informed investment decisions. Warning sign number 5. Excessive borrowing. The fifth warning sign of a potential stock market crash is excessive borrowing. When companies or individuals take on too much debt, it can become difficult to make payments or service that debt if economic conditions worsen. Excessive borrowing can be caused by various factors, such as low interest rates that encourage borrowing, a desire to expand a business or purchase assets, or speculation in the market. When borrowing becomes excessive, it can lead to a bubble in asset prices, such as the housing market bubble that led to the 2008 financial crisis. Investors should be wary of companies that have taken on excessive debt, as they may be more vulnerable to a stock market crash or economic downturn. One way to monitor a company's debt levels is to look at their debt-to-equity ratio, which measures the amount of debt a company has relative to its equity. In response to excessive borrowing, investors may want to consider reducing their exposure to highly leveraged companies, or to companies that are heavily exposed to interest rate risk, such as financials or real estate. Instead, investors may want to consider more defensive sectors such as utilities or consumer staples. Overall, excessive borrowing can be a significant warning sign of a potential stock market crash, and investors should be cautious of companies or individuals that have taken on too much debt. Warning sign number 6. Unemployment rates. The sixth warning sign of a potential stock market crash is rising unemployment rates. When unemployment rates are high, it can indicate that the economy is troubling, which can lead to a decline in consumer spending and a decrease in corporate profits. Unemployment rates can be affected by various factors, such as changes in government policies, shifts in the economy or industry, or global economic conditions. In addition, technological advances or changes in consumer behavior can also impact employment levels. Investors should be aware of the industries or sectors that are particularly vulnerable to high unemployment rates, such as consumer discretionary, financials, or energy. Companies in these sectors may experience declining revenues or profits if consumers are struggling to make ends meet or if the economy is contracting in response to rising unemployment rates. Additionally, investors may want to consider reducing their exposure to companies or sectors that are particularly vulnerable to high unemployment rates. Overall, rising unemployment rates can be a significant warning sign of a potential stock market crash, and investors should stay vigilant and monitor employment levels to make informed investment decisions. Warning sign number 7. Political instability. The seventh warning sign of a potential stock market crash is political instability. Political instability can take many forms, such as civil unrest, changes in government policies, or international dispute. When political instability occurs, it can create uncertainty in the markets, leading to increased volatility and a potential decline in stock prices. Political instability can also impact specific industries or sectors, such as those that are heavily regulated or dependent on government policies. Changes in policies or regulations can impact the profitability of these companies and lead to a decline in their stock prices. Investors should monitor political events and developments, both domestically and internationally, to assess the potential impact on the markets. In response to political instability, investors may want to consider reducing their exposure to companies or sectors that are heavily impacted by government policies or regulations. Additionally, investors may want to consider diversifying their portfolio internationally to mitigate the impact of political instability in a particular country or region. This can include investing in companies or funds that have exposure to multiple countries or regions. Overall, political instability can be a significant warning sign of a potential stock market crash, and investors should stay informed and adjust their portfolios accordingly to mitigate potential risks. Warning sign number 8. Geopolitical tensions. The eighth warning sign of a potential stock market crash is geopolitical tensions. Geopolitical tensions can arise from conflicts between nations or regions, international trade disputes, or military disputes. When geopolitical tensions are high, it can create uncertainty in the markets, leading to increased volatility and a potential decline in stock prices. Geopolitical tensions can also impact specific industries or sectors, such as those that are heavily dependent on international trade or those that have exposure to particular regions. For example, if there are tensions between two countries that are major trading partners, it could impact the profitability of companies that rely on the trade relationship. Investors should monitor geopolitical events and developments, both domestically and internationally, to assess the potential impact on the markets. In response to geopolitical tensions, investors may want to consider reducing their exposure to companies or sectors that are heavily impacted by international trade or relations with particular countries or regions. Additionally, investors may want to consider diversifying their portfolio internationally to mitigate the impact of geopolitical tensions in a particular country or region. This can include investing in companies or funds that have exposure to multiple countries or regions. Overall, geopolitical tensions can be a significant warning sign of a potential stock market crash, and investors should stay informed and adjust their portfolios accordingly to mitigate potential risks. Warning sign number 9. Asset bubbles. The ninth warning sign of a potential stock market crash is asset bubbles. Asset bubbles occur when the prices of assets, such as stocks, real estate, or commodities, rise to unsustainable levels that are not supported by the underlying fundamentals of the market. When an asset bubble bursts, it can lead to a significant decline in the value of the asset and potentially impact the broader markets. Asset bubbles can be difficult to identify, but some warning signs include rapid price increases that are not supported by the fundamentals of the market, high levels of speculation, and excessive leverage or borrowing to invest in the asset. Investors should monitor asset prices and valuations to assess whether they are supported by the underlying fundamentals of the market. In response to the warning sign of asset bubbles, investors may want to consider reducing their exposure to assets that have seen rapid price increases and are not supported by the fundamentals of the market. Additionally, investors may want to consider diversifying their portfolios to include a mix of assets that are less likely to be impacted by asset bubbles. For example, investing in fixed income securities or alternative assets, such as commodities or real estate, can provide diversification and potentially reduce the impact of a potential asset bubble. Overall, asset bubbles can be a significant warning sign of a potential stock market crash, and investors should stay informed and adjust their portfolios accordingly to mitigate potential risks. Warning sign number 10. Insider selling. The 10th and final warning sign of a potential stock market crash is insider selling. Insider selling occurs when executives and other insiders of a company sell a large number of shares in the company's stock. Insider selling can be a warning sign that insiders believe that the company's stock is overvalued and may be due for a decline. Investors should monitor insider selling activity, especially in companies where insiders have a significant ownership stake. In response to the warning sign of insider selling, investors may want to consider reducing their exposure to the stock or the sector where the insider selling is occurring. It's important to note that insider selling is not always a reliable indicator of a potential stock market crash. Insiders may sell for a variety of reasons, including to diversify their portfolios or to raise funds for personal expenses. Investors should also be aware that insider buying, or when executives and insiders purchase shares of their company's stock, can be a positive signal for the company and the broader market. Insider buying can indicate that insiders believe that the company's stock is undervalued and may be due for an increase. Overall, insider selling can be a warning sign of a potential stock market crash, and investors should stay informed and adjust their portfolios accordingly to mitigate potential risks. In conclusion, there are 10 warning signs that investors should watch for to help identify a potential stock market crash. These warning signs include high market valuations, rising interest rates, economic slowdowns, falling corporate profits, excessive borrowing, unemployment rates, political instability, geopolitical tensions, asset bubbles, and insider selling. While these warning signs do not guarantee a stock market crash will occur, they can help investors make informed decisions and take steps to mitigate potential risks. Investors can monitor economic indicators, market valuations, and insider activity to stay informed and adjust their portfolios accordingly. In response to these warning signs, investors may want to consider reducing their exposure to stocks or sectors that are particularly vulnerable react to market declines, such as high-growth stocks or cyclical industries. Additionally, investors may want to consider diversifying their portfolios to include a mix of assets that are less likely to be impacted by a potential stock market crash, such as fixed income securities or alternative assets. Ultimately, investing in the stock market involves some degree of risk, and there is no foolproof way to predict a market crash. However, by staying informed and monitoring the warning signs, investors can make informed decisions and potentially reduce the impact of a market downturn on their portfolios. So there you have it, the top 10 warning signs of a stock market crash. As investors, it's important to be aware of these signs and to make informed decisions when investing. If you found this video helpful, be sure to give it a thumbs up and don't forget to subscribe to our channel for more finance-related videos. Thanks for watching.